Use the following scenario to answer the questions. Ben is a wholesaler of motorcycle helmets. It is 1st of January 2002. Credit sales in the last quarter of 2001 were as follows. So they have given the credit sales for the last quarter of 2001. So October 2000 units, November 2000 units, December 2500 units. And they have given the first quarter of 2002 credit sales as well. So his credit sales in the first quarter will be as follows: January 3000 units, February 5000 units, March 4500 units. And they have given some additional information. Customers are given 60 days credit and the average selling price is $10. So customers are given 60 days credit. 60 days credit. A price rise of $1 is planned in February. Price rise of $1 is planned in February. His biggest customer Mixter is given a 2% discount for paying cash when the sale is made. Mixter is planning to buy 150 helmets in January and 250 helmets in March. And the sales to Mixter are in addition to those credit sales status above. Mixter is paying at the point of sale. Paying at the point of sale. So sales information is done. So let's read the purchase and other informations as well. Purchase an average of 30 days credit, $4 per helmet. Ben plans to buy the helmets a month in advance, a month in advance of selling them. Total overheads are $2,000 per month. This includes $400 depreciation and wages of 1,000. All other overheads are paid for after a credit period of 30 days. And Ben plans to inject a further 5,000 of his own money into the business in March to help to buy non-current assets for 29,000. These assets will be depreciated over 5 years. Opening cash flow is negative 4,550, which is close to Ben overdraft limit of $5,500. So this is the scenario. Using the scenario, we have to answer for multiple questions. So the first question is calculate the total cash inflows, calculate the total cash outflows. So in order to approach the question, let me prepare the entire cash budget. After that, using the cash budget, we can answer for the question one by one. One by one. So first of all, if we prepare the sales, if we prepare the sales, we have October and November and December, and we have January and February and March. So if we look at the figures, for October 2000 units, for November 2000 units, for December 2500 units. For October 2000 units, for November 2000 units, for December 2500 units. And next year, January 3000 units, February 5000 units, March 4500 units. So January 3000 units, February 3500 units, February 5000 units, March 4500 units. 4500 units. So selling price per unit is $10. So $10, $10, $10. Here also $10. But for February and March, the selling price per unit will be $11 because in the question they have mentioned a price rise of $1 is planned in February. A price rise of $1 is planned in February, which means $1 price increment will be there in the month of February and March and follows. So But what are they telling? Customers are given 60 days credit and the average selling price is $10. So customers are given 60 days credit. So October sales will be $20,000. November sales will be also $20,000. December sales will be $25,000. January sales will be $30,000. February sales will be $55,000. March sales will be $49,500. $49,500. But we are not taking the payment. We are not getting the payment soon after the sales. Customers are taking 60 days to make the payment. So whatever the October's cash, this 20,000 we will receive in the month of December. December. Because November, December. Whatever the sales which we have done in November, the cash for those sales we will receive in the month of January. For December sales, we will receive the cash in the month of February. For January sales, we will receive the cash in the month of March. For February sales, we will receive the cash in the month of April. For March, we will receive the cash in the month of May. In the month of May. So this is the normal sales. And there is one more thing. There is a special customer called Mixter. Customer called Mixter. So I'll write his sales details separately. So if you take Mr., what are they telling? His biggest customer, Mixter, is given a 2% of discount for paying cash when the sale is made. Mixter is planning to buy 150 helmets in January and 250 helmets in March. So Mixter is purchasing 150 units, 150 units in the month of January, 150 units in the month of January. In March, he is purchasing 250 units. 250 units. So in the month of January, the selling price per unit is $10, but in March, the selling price per unit is $11. So the total sales for the month of January will be 1,500. For the month of March will be 2,750. And in the question they have mentioned Mixday is paying the cash soon after the sales in the same month. But when he is paying the cash, as the company, we are giving a discount of 2%. So our cash receipt from the Mixday will be 1,500 into 98% for the month of January. For the month of January. So that will be 1,470. For the month of March, 2,750 into 98%, that will be 2,695. So let me prepare the cash budget. Let me prepare the cash budget. So if you prepare the cash budget, first of all, we have to take the cash inflows. First of all, we have to take the cash inflows for the months Jan, February, and March. So first of all, we'll record the normal sales. For the Jan, we are getting a cash flow of 20,000. 20,000. For February, we are getting a cash flow of 25,000. For March, 30,000. So these sales proceeds are from normal sales, but there is a special customer who is Mixter, So the cash inflows from Mixter for the month of January, we will get a cash inflow of 1,470. sorry, 1,470. For the month of March, we will get a cash inflow of 2,695. So these are the recordings which we need to make in terms of sales. Now let's look at the information of purchase. Purchase an average of 30 days credit. An average of 30 days credit are $4 per helmet. Ben plans to buy the helmet a month in advance of selling them. So understand, people, understand. If you need the helmet, if you need the helmet for the month of January, you need the helmet for the month of January, you will purchase those helmets 1 month prior to the sales. 1 month prior to the sales, which means this is the need. The purchase will happen 1 month prior to the sales, which means in December. In December. But the payment will be made after 30 days after the purchase, which means 1 month after the purchase, which means payment will be made in the month of January. In the month of January. For February's helmet, for February's demand, you will purchase the required helmet in the month of January, but you will make the payment in the month of February. For March demand, you will purchase the required helmet in the month of February, but you will make the payment in the month of March. In the month of March. So what is the demand for the month of January? For the month of January, we need 3,000 units of helmet. On top of that, we need another 150 units for mixture. So 3,000 units plus 150 units. For the month of February, we need 5,000 units. We need 5,000 units. For the month of March, we need 4,500 units. On top of that, we need another 250 units for mixture. So 4,500 plus 250. So this is the requirement. But you will purchase these helmets in the month of December. So for December, 3,150 into $10, and not $10, purchase price is $4. Sorry, I made a mistake. Purchase price is $4. For the month of January, 5,000 helmet, purchase price is $4. For the month of February, in the month of February, you will purchase 4,750 helmets, $4 per helmet. So your total purchase cost will be, in the month of December, 3,150 into 4, it will be 12,600. It will be 12,600. 12,600. For the month of February, will be 20,000. For the month of March, it will be 19,000. 19,000. So let me repeat it shortly, people. Understand it properly. So they are telling whatever the required helmets will be purchased 1 month prior to the demand, 1 month prior to the sales. So if you need those helmets in the month of January, you will purchase those helmets in the month of December, 1 month prior. But you will make the payment after the 1 month after the purchase, which means for December's purchase, you will make the payment in the month of January. So this 12,600 cash outflow will happen in the month of January. Next one, for February's demand, you will purchase the helmet in the month of January. You will make the payment 1 month after the purchase, which is February. This 20,000 cash outflow will happen in the month of February. Next one, March, you will purchase 1 month prior, which means February. You will make the payment 1 month after the purchase, which is March. So this 19,000 cash outflow will happen in the month of March. So let me put the figures in the cash budget. So cash outflows, purchase in the month of January, you will have a purchase cost of 12,600. In the month of February, you will have 20,000. In the month of March, you will have 19,000. You will have 19,000. The next part, total overheads are $2,000 per month. This includes $400 of depreciation and wages of 1,000. So for each and every month, you have an overhead cost of $2,000. I'll write it here. You have an overhead cost of $2,000. Out of this $2,000, $400 is related to depreciation, which is a non-cash item. Depreciation. The remaining 1,600 is cash. The remaining 1,600 is cash. And in that particular 1,600, you have wages of $1,000. You have wages of $1,000. Wages of $1,000. And the remaining 600 will be your overheads. Your overheads. So what are they telling? All other overheads are paid for after a credit period of 30 days. But they haven't given any information about wages payment. So we can assume whatever the wages payment will be paid in the same month itself. And all other overheads are paid for after a credit period. So in December, you will have an overhead cost of 600 that will be paid in January. January's overhead cost will be paid in February. February's overhead cost will be paid in the month of March. So anyway, you will have the same cost for Jan, Feb, March. So wages 1,000 for February as well, 1,000 for March as well. The overheads 600, 600, 600. Ben plans to inject a further $5,000 of his own money into the business in March. So Ben is injecting further 5,000, which means he is investing a 5,000 in his business on the month of March. Month of March. So injection, it's a cash inflow for the company. The month of March, that is 5,000. 5,000. In March to help to buy non-current assets for $29,000. These assets will be depreciated over 5 years. Since we are preparing the cash budget, we don't need to consider about the depreciation. So this 5,000 is investing in order to purchase non-current asset which is worth 29,000. So if he is purchasing non-current asset, there will be an outflow of 29,000 in the month of March. So opening cash flow is negative 4,550, which is close to Ben overdraft limit of 5,500. So these are the information. So let's prepare the cash budget. So if you take the net cash flow for the month of January and February, if you take the net cash flow for the month of January, will be 20,000 plus 1,470 minus 12,600 minus 1,000 minus 600, it will be 7,270. 7,270. If you take the net cash flow for month of February, it will be 25,000 minus 20,000 minus 1,000 minus 600. It will be 3,400. If you take for March, 30,000 plus 2,695 plus 5,000 minus 19,000 minus 1,000 minus 600 minus 29,000 is giving a negative balance of $11,905. $11,905 negative balance. So if you take the opening balance, you take the opening balance, they have told opening cash flow is negative 4,550. So for the month of January, it is negative 4,550. So you will get the closing balance. So 7,270 minus 4,550, 2,720. So the closing balance of the month of January will become as the opening balance for the month of February. So 2,720 plus 3,400, it will be 6,120. The 6,120 closing balance of February will become as the opening balance for month of March. So that will be 6,120. So March closing balance will be negative 11,905 plus 6,120, it will be 5,785 negative cash flow. So this is a problem in this organization because because the company Ben has an overdraft limit of 5,500, but his budgeted cash forecast is exceeding the limit and it is going up to the 5,785. So he needs to talk with the bank in order to increase the overdraft limit. If not, he needs to compromise any of the cash outflows. He needs to postpone it. So based on this, in order to stick with the bank's policy, he needs to take the proper action. So now we have prepared the cash budget. Using this cash budget, let's answer the question one by one. So the first question, calculate the total cash inflows for month of March. So if you take the month of March, you have sales of 30,000. You have mixture sales from mixture, which is 2,695, and you have injection of 5,000. So it will sum up to 1,000 plus 2,695 plus 5,000. So for the month of March, you will have a total cash inflow of 37,695. 37,695. Second question, calculate the total outflows for the month of January. Total outflows for the month of January. If you look at the month of January, we have outflows is 12,600, 13,600 plus 600, 14,200. 14,200. Third question, calculate the purchase outflow for the month of February. They are asking the outflow which is related to purchase in the month of February, which is related to purchase. So in the month of February, in relation to purchase, our outflow is $20,000. $20,000. Fourth question, calculate the cash balance at the end of March. So we have calculated this is 5,785. 5,785 negative. Negative. Fifth question, which of the following is a disadvantage of using a cash budget? It doesn't take into account non-cash item. Yes, in cash budget, we are not considering the non-cash item. So eventually we can't calculate the profit. So this is the disadvantage of cash budget. If you look at the statement B, it doesn't provide information about the timing of cash inflows and outflows. No, that is wrong. When we are preparing the cash budget, we are considering the timing. What is the cash outflow of February? What is the cash outflow of March? So like we did in the previous, before 10 minutes. And option C, it is too time consuming to prepare. That is also wrong. Once you get used to prepare this cash budget, you will be able to prepare the cash budget quickly. Option D, it assumes that all customers will pay on time. No, we are not assuming like that. We are considering the payment date and payment month separately, and we are recording the recordings properly. So option D is also wrong. So the correct answer for the fifth question is option A.